Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to start off today talking about the economy. So there have been a lot of reports lately that were on the positive side, more positive than expected in terms of the numbers reported, but we also have quite a few conflicting reports where numbers came in a little bit weaker than expected. And we're coming off of a first quarter that showed declining economic growth, which could be setting the stage for a potential recession if it's repeated this quarter. Everything seems to be up in the air. With numbers going one way or the other, it's hard to get a clear picture. We're going to try to do that right now with the numbers that are on the horizon over the next couple of weeks. So earlier, I should say later this morning on the 21st, we're going to get a reading on the leading economic indicators index, which over long periods of time has tended to correlate with future both path and magnitude of economic growth or decline in economic growth. That said, recent history leads us to kind of discount the importance of this indicator. It's been reading negative for quite some time, and yet we haven't seen an actual recession develop yet. That could all change when the next GDP reports come out, but it doesn't look likely that we're going to see that recession now, and we are somewhat discounting this indicator. Even if it comes in at the expected 0.3% decline in its index, we're not necessarily thinking that correlates with odds of a recession at the moment because the water is just so muddy. We'll get later in this week information on the real estate market, we get information on the labor market, and here's one of these conflicts that we're talking about. You can see initial jobless claims is expected to tick up slightly, and this has been ticking up slightly over the past several periods, several months even, and it indicates that maybe there are some weakness starting to come into the labor market, which would be problematic and which would be a recessionary indicator. So we want to keep watching that. The labor market is a key part of that calculus. We'll see what's going on in terms of outlook with the purchasing managers index, and again, that's expected to show a little bit of a decline. Yet we've been recently getting reports that things look better than expected. The outlook going forward appears to be pretty sour, and that isn't a really great indicator. If the outlook is sour, that means that investment decisions by businesses are likely to be tabled for the near future, which would tend to correlate with a slowdown in economic growth. So again, that one bears watching. What's happening with the outlooks tends to lead to spending, which tends to lead to GDP growth. So we want to watch this stuff. We'll get more real estate information. We'll get the durable goods orders and the capital goods orders. These are big ticket items, and this is key to understanding demand conditions in the economy, and that's expected to show a decline as well. A relatively big one, 10.5% decline, coming off the heels of a 16.5-ish% rise on the last period. So if demand is turning south in actuality, as these numbers here, the actual orders numbers indicate, and in outlook in terms of future demand, which these numbers indicate, that's a pretty recessionary outlook. However, we've had some other things in terms of retail inventories and wholesale inventories and consumer spending at the actual level that indicate that maybe there's a resurgence in strength coming into the economy, and this isn't reflected on this screen yet. There is no consensus on what the wholesale inventories are going to look like or the retail, but if we start seeing negative economic reports and inventories are building at both of these levels, that means goods are going unsold. That would indicate, a recessionary indicator. And on the other hand, if the inventories are shrinking, that would indicate that stuff is kind of flying off the shelves, at least at the retailer level. And, maybe the wholesaler inventories are growing in response to that to provide demand to supply. If we see that configuration, that indicates some health in the economy. So we're watching that really carefully. Here's consumer confidence, which is expected to rise, and this is interesting. Here's another positive signal. If consumers are happy and consumers are spending, and consumer spending is representative of most of the GDP growth number, this is actually a sign that we are probably in a position to dodge that recession bullet and not get declining economic growth. And we can kind of put an exclamation point on that last statement, whereas for Q2, they're expected to show a 2.5% economic growth number at the annualized GDP quarter on quarter level versus a negative 0.5% in the first quarter. That would be a large about face, and that would show a pretty strong resurgence in the economy. And this number being that high tends to indicate that it's probably going to fall into the positive range. In other words, it's going to be above flat. It's not going to be declining. So we're not expecting that recession call yet. We're still on the lookout for it. It's not that we're out of the woods, but it does look like we may be out of the woods, at least for now. And whether or not we see a recession in the future is going to depend on what the Fed does and what happens with inflation. And that's where we're going right now. When we see the core PCE price index, the last time that came out was 3.5%. Well, that number is pretty unacceptably high to the Federal Reserve, and it's going to tie their hands. There's been a lot of jawboning out of Washington about forcing the Fed's hand to lower rates to make the cost of money, lower, and to stimulate the economy and economic growth. That can't happen when you have inflation running at 3.5% and the Fed is always targeting 2. Maybe they're targeting 2.5. Even still, this number is running too hot. If it comes in the same way on this next reading on the 30th, that's an argument that they cannot possibly hike or lower rates. In fact, what it says here, I would read this to say the Fed actually should be hiking rates, not cutting them. And the expectation is that Fed is going to just sit tight and do nothing. That remains to be seen. But if that inflation number ticks up and comes in hot, they're going to have to raise rates, and that is going to put the brakes on economic growth pretty rapidly from the rate levels that they are now. We're not coming from that zero interest rate world that we were in during the COVID era or during the Great Financial Crisis era. So let's look now to what's happening here. Here's another core PCE year over year. That one here is expected to show 2.8%. So it's a little bit closer to what we're looking for. If they're looking for 2.5%, I don't think they are. They say they're looking to get it down to 2% over time, and it's going to trickle down. But regardless of the magnitudes that these numbers are coming out, if you look here, it's going the wrong way. 2.7 to 2.8. That's not the direction that we want to see rates go, and if rates spike again, that has implications for stock market pricing and economic growth. So we'll keep watching, and we're looking at the non-farm payrolls. Again, here's another labor market number that's expected to show, this is going to be potential cracks in the labor market. When you see non-farm payrolls going up by only 110,000, and they were only going up by 147,000 in the prior month, and they were going up by over 200,000 for months and months and months, and sometimes much more than 200,000 every month. That's a clear sign that, job growth is decelerating. And if that happens, that's another recessionary indicator. So you can see what I'm talking about here. Flip-flop, good, bad. It's hard to make sense of what's going on. And we're not necessarily going to want to do that. We want to respond, and we want to position ourselves in such a way that if the economy tips into recession, we're well defended, and if it doesn't, we're well positioned to take advantage of the growth situation. And that's really what the investing philosophy that we have is all about, optimal positioning. And now we'll look here, finally, coming down the pike, more sentiment indicators to round us out into the 1st of August. Can you believe it's already almost August? That's a tough one. Year's going by really quickly. So, hitting earnings season really briefly, 179 out of 202 reported in the last month, the 202 being the number due up till now over the last month. And overwhelmingly, we're seeing a sea of green, except in the communications companies, where we see a decline on the earnings, in terms of a surprise. That's been down. They've been surprising to the downside in communications. but overwhelmingly to the upside everywhere else sector-wise. And this doesn't really make a lot of sense if we're in a recession. So we're going to keep watching earnings season. This is not a large proportion yet of the S&P 500 having reported. Reasonably decent, but not a large portion. What's going on with the S&P? Well, from the April lows, we are now up 30%. And just since, May, let's talk about that. So there is an old adage on Wall Street, sell in May and go away. And what that means is, the markets tend to be real placid, not really go anywhere, not do much. So basically go away, have vacation, don't look at the market and sell your stocks, come back in the fall, and it's time to get back into positions. Well, if you'd have done that this year, you missed out on a 12% run to the upside that we're trading at the high of right now. So obviously this year, that adage is failing. That's not a good adage to have used, and the markets have largely recovered. And we're up 30.2% from April's lows. That is a massive recovery, and indicates that maybe we're going to find stability, particularly when you see a pattern like this where it's tight and it's near the top of the range, just kind of treading water. We like to see that type of a pattern. Not that we're into technical analysis in any meaningful way, but it does show strength in the market. It shows that whenever there's sellers trying to liquidate, there's someone there to buy, and it's holding prices kind of at a stable level, looking for catalysts to the upside potentially. Could it go down? Sure. And there are a lot of potential catalysts there. But when you tend to see that pattern, you do tend to see a continuation pattern out of it. So we're not expecting anything major over the next few weeks, but the market seems to be positively well balanced right now. And when we look to the longer term, again, you can see this vicious decline that we had at the beginning of the year. I think it's important to note that when we look at these charts, as you come closer to the present moment, that tends to exaggerate the appearance of the patterns because these charts are in real numbers, not the logarithms, which are, a percent change adjustment. So, if we did a logarithmic chart, everything would look proportionally correct. So this decline that we had was not bigger than the one in 2022, nor the one in 2020. However, it looks like that when we're looking at the chart, and that's a big error that investors can make when they do look at charts if they don't remember that fact. So remember that fact when you're looking at your charts, and look for it to be a logarithmic chart if you want to avoid that kind of distortion in the mirror type effect. But we're trading at all-time highs, and we've seen periods of volatility over time, and what that indicates is you don't want to be selling into panics, and you don't want to be buying manias either. You don't want to be buying up here and then have it dip. You want to be disciplined. You want to be going in slowly in a disciplined manner with a goal in mind, and then just working toward that goal. We don't want to be trading emotionally, and this just hammers it right out. And this one's interesting. So the MSCI EFA, without the United States in it, in terms of economic growth, or in terms of equity market cap, I should say, that is showing all-time highs, and this actually has had a pretty strong recovery as well out of the recent lows. In fact, if you look at the shape of that recovery, it was much stronger than the recovery in the United States. And that's an argument that we need to start looking to outside the U.S. For some compelling return opportunities in equity markets. So whereas over the last, say, 15 or so years, it's been beneficial to just own domestic large cap equities, that situation looks to be changing now, and we probably want to be looking over in Europe and in developed Asia for more opportunities to add to our portfolio. In our team's approach, we have added to our international exposure in the developed world. We are not adding to our emerging markets exposure, but we are adding to the developed markets exposure. Moving into rates, there has been a pretty pronounced move downward in the yield curve since the beginning of the year. And that's mainly due to reduced expectations for economic growth and, potential trouble in the economy, and a flight to safety trade that was happening due to volatility. However, with rates down here, On the shorter end of the curve, everything's lower than it was, but on the long end of the curve, 20 years and out, actually more like 17 years and out, we're actually looking at a curve that's higher. And what does that tell us? That tells us that the long-term expectation that investors have, the long-term bond investors who are among the sharpest in the pool, so to speak, are raising their inflation expectations. They don't want to loan money to the government and have the government pay money back to them that's worth less due to inflation. So they are raising the amount of interest that they demand in order to buy the debt, or in other words, loan that money to the government, because they see the inflation risk being higher out over the long term. And that's another kind of sign. Maybe the Fed is not fully in control of inflation where things are, and if there's some more pressure from Washington that becomes powerful enough to cause them to act, this could get worse. So we're watching it, but rates are pretty good for a treasury. I mean, 1-year treasury at 4%, 10-year treasuries at 4.37. Not bad. You can get close to 5% 20 and 30 years out for the so-called risk-free asset. Now, coming into corporate bonds, the decline is also present since the beginning of the year in the yield curve on the short end, and it's rising starting at 15 years above where it was when it opened the year. And what's going on here? A 2-year treasury note went down by 40 basis points in yield. A 2-year corporate bond only went down by 28 basis points in yield. Why? Because economic conditions have become a bit tenuous. There is a default risk premium in these corporate bonds, and that is going to cause yields to not decline as much. In other words, investors are going to demand a little bit higher of a yield in order to loan money to corporations, proportionate to their estimates of risk of default in the issuers. And so this kind of indicates things are looking a little fragile in terms of that. Not so much because of the decline, because it is still declining. So those bonds are still falling in yield, but it's showing that the credit risk that's in there is not falling by as much as the inflation risk over the short term. And that could indicate some oncoming stress on the issuers, or in other words, coming into the overall marketplace. So we're watching it. But again, kind of coming back to close out like we do, we want to have a long-term disciplined approach that we know works to help you achieve your goals. We're here to talk about this stuff anytime that you like. Feel free to do that. Hope you found the video useful. Thanks and have a great day.